I think we described the state of the current private equity market as we enter 2026 as defined by building momentum. It really didn't feel like it, but last year was actually one of the more active years that we've seen for private equity. However, the market's really defined by a small number of really large transactions. And that's one of the things that folks are going to be watching for as we move into the new year, is the degree to which the market starts to broaden out from that base. I think we're starting to see that now, where the middle market, for example, is starting to heat up quite a bit. Right now, about 80% of the firms that we talk to expect that transactions are going to increase over the next 6 months or so. And there's a number of reasons for that, right? There's the decreasing cost of capital, there's more assets that are just coming to market, and in particular, there's a narrowing of the bid-ask spread that we're seeing right now. GPs are going to lean on earnouts, holdbacks, other kinds of valuation bridges to help mitigate some of that macro uncertainty that we're seeing. And in particular, it's going to be operational capabilities that are going to define success. Well, I think the big shift that we're seeing from an exit perspective is that trade buyers are back as buyers for private equity assets. Last year, the value of those sales was up 75% versus the prior year. Corporate boards had sort of been sitting on the sidelines for a long time, but now they're starting to get much more involved as buyers for PE assets. And that's leading to a sharp increase in sentiment. According to our latest survey, about 3/4 of GPs right now expect that exits will increase over the next 6 months or so. That's up from 44% when we asked at mid-year.